The following is a presentation of TFNN. Live at TFNN. The Money Masters. Now, the Money Masters.
Good day, Money Masters and Treasure Hunters. Welcome to the June 4th terrific Tuesday edition of the Money Masters Show. I'm your host, Steve Rhodes, and I am grateful for your presence here today. My outcome, as always, is to help you to become a better money master and to provide you with tools that empower human potential, because living up to our potential, folks, that is something we must master each and every day. So let's begin with an empowering belief or two. Let's start with the first one. Let's talk about a pessimist and an optimist. You know, a pessimist is one who makes difficulties of his opportunities. An optimist is one who makes opportunities of his difficulties. Think about that, folks. Which are you, an optimist or a pessimist? You know, opportunity, it's rare, and a wise man will never let it go by. That was said by Bayard Taylor out there. Here's one from Washington Irving. It is interesting to notice how some minds seem almost to create themselves, springing up under every disadvantage and working their solitary but irresistible way through 1,000 obstacles out here. Let's finish it off with one of my favorites. Look for the best of what can be possible in every situation. I think, folks, that is the way to live. Look for the best of what can be possible in every situation, and then you have the opportunity to turn any problem into a manifestation of greater good out here. Let's go check out these markets. Let's see what they're going to manifest right now. We've got the Dow up 22 points, trade at 15,276. S&P up almost $2.50, trading at 1642.99. NASDAQ up 7 points, 7.5, trading at 34.72. Russell 2000 up 40 cents, trading at 990. NASDAQ 100 up 7 points. The New York Stock Exchange up 17 points, almost leading the charge here to the upside. That's trading at 93.74. We're going to start off by taking a look at the New York Stock Exchange. We've got gold back, $12 right now at $13.99. Silver off 29 cents, trading out at $22.42. Light sweet crude off 48 pennies. The King dollar up 18 cents right now. If we take a look at what's going on across the pond in Europe, we've got the DAX is up 27 points. The FTSE up 40. Last night, the Nikkei had quite a session. We'll take a look at that Nikkei chart. Nikkei was up 271 points, up 2%. Flat in the Hang Seng, and down about 1%, a little over 1%, 28 points in the Shanghai. Our call-in number is 877-927-6648. Net advancing issues. Oh, there aren't any. It's net declining issues. Down 84 right now. So we're going to start off, take a look at the New York Stock Exchange. To me, it's as clear as bell that the trend here has changed. We take a look at that. We take a look at that key reversal session from May 22nd out here as the New York Stock Exchange tested the top of its rising price channel. So you had a bearish engulfing, a key reversal session. We then had an island reversal session that took place here on May 28th. There you go. So you got two bearish candle patterns out here. We saw a little hammer that actually formed on May 24th out here. That low was 93.76. That got taken out. That got taken out on Friday with a move lower, a little bit lower low actually yesterday. Now we're seeing a change in trend. There's a tool that I use down here at the bottom. I may be doing a newsletter report on that. I'm going to do a special newsletter out here. I just have so many topics and so many things that I've been working with. I'm trying to figure out which one to do. Maybe some of it will call for a little workshop out here. But the change in trend is very clear to me inside the New York Stock Exchange. That change in trend should really take us down to the bottom of the rising price channel, maybe even lower than that. Let's take a look at where the 200-day exponential moving average was on May 1st, on April 29th out there. As soon as I can find it, I know it's right here in front of me. There we go. The 200-day exponential moving average on April 29th. Let's use the April 30th. I don't know why I say the 29th. That number was 85.84. So 85.84. Right about here. In fact, if I were to draw a line across, I might as well do that. So let's come down here to April 30th. Let's see if we've got an intersecting area. Pretty close. No cigar. Would it be pretty close out here the bottom of the channel, that's really where I expect that we will see the New York Stock Exchange get somewhere down into that area. I'll keep this line here on my screen, or maybe we'll come back and put it out there at another day if I do remove it. So in the New York Stock Exchange, to me, it says it wants to move down. We are seeing weakness, substantial weakness inside the New York Stock Exchange. Let's go take a look here at the S&P 500, and we'll start taking a look at any kind of candle formations out here in the trading sessions. We'll take a look at yesterday's as well. Let me pull up the S&P 500. The S&P 500, when we were talking yesterday, I didn't mention this during the first hour, so might as well come back to it. Remember, I know I spoke about it during the second hour of yesterday's show as well, and that was that we saw a one-day increase in the VIX index. In this case here, it was 12% on Friday. And whenever you have something greater than 10%, 60% of the time, historically speaking, 60%, over 60%, I think it's 64% of the time, what you'll see on the next trading session is a close higher. I mentioned that yesterday, so the probability was in our stead. If you go back and you take a look at coming off of the lows here from November 16th, it's actually we now have 8 out of 10, 80% of the time when you see a VIX a day with the VIX in excess of 10%, you have seen a bounce that very next trading session. That's exactly what took place here yesterday. If you went ahead and you used the ES Mini, if you used the futures contract, and you look at patterns down there, you can see when that bounce was going to take place. You had in this case here, it was 7 out of 9, so that's 80%, maybe a little. That still is obviously a nice probability when you take a look at just simply coming off of the November lows, but even still a 64% chance. I'll take a 64% chance any day of any week out here, and that's really what took place yesterday. No bullish candle forming inside the S&P 500. Right now, today, the S&P 500 has gotten up, and it has tagged that blue line, which is the 9-period exponential moving average out there. And right above that is the 1650 primary trading range boundary line. That's in the S&P 500. That, too, having a key reversal session here on May 22nd, as all of the indexes did. I believe almost all of the indexes did inside the marketplace. You had that bearish engulfing candle as well. So the S&P 500, where is it going to go? Well, it's going to head down into longer term. It's going to be pulling back into the level of about 1470 at a minimum. That's that 200-day exponential moving average as of April the 30th. Let's go take a look at the, let's see, what's next up on the screen. The Russell 2000. So let's go see what the Russell 2000 is doing. Yesterday's candle, I should say, was in fact a hammer candle. And the reason is this, folks. There's been enough of a decline coming off of the high out here. That high being the key reversal session of May 22nd. Also the second high that was created here on May 28th. So there has been enough of a decline out here for this to be an actual hammer candle. Now, that's important for us, and it's important for a couple of reasons. Number one, paying attention to the low of yesterday, 976.05, is very key. And the reason is because when you close below a hammer candle, if you're long, you're wrong. And so inside the Russell 2000, our expectation is going to be that the Russell will come down and move down into this gap up area, which is also going to be a test of that May Day high, 945.53. We know there was substantial volume off of that session here. You've got a small gap that is just below or above, just above that, and that's the gap that was created on May 3rd. The low of that gap is 946.94. The top of that high volume bar out here is 945.53. That is where the Russell 2000 wants to head to. But first, it's going to have to get through the bulls, that hammer candle that was formed yesterday. And but that is really where it wants to go. Just so what is cool about this is you would actually take a look at adding, if you were in a position, let's say inside TZA, or you weren't and you were looking to get in, you could just simply wait till you see a close below 976.05 out here. Yeah, all it has to really clear is this swing point from May 23rd, and then it doesn't have anything to stop it in its place until it gets down to that gap and that high volume bar from May Day out there from May 1st. So you did have some bulls show up inside the marketplace yesterday. One of those areas was the Russell 2000. We'll take a look at the ETF structure here separately in a minute or when we get back from break. But let's go run over and take a look at the NDX 100. So we'll take a look at the NDX, see what it did yesterday. Right now, it's trading out at 29.98, and really the same thing as we took a look at inside the Russell 2000. It created a hammer candle yesterday. Now, what is interesting about this is that hammer candle coming into that gap-up session, that little breakaway session from May 3rd out here. The top of that bar is 29.52. The low yesterday was 29.50.87 out here. So you've got a hammer candle. We also have that key reversal session out here. So it's enough of a decline off of that top candle from May 22nd. It's enough of a decline as well as off of the May 28th out here for this to form a hammer candle inside the NDX 100. That says that you've got strong support inside the NDX at 29.50.87, which coincides with that breakaway day on May 3rd out here. The low of that gap is 29.37. You get a close below that, that's going to set up a run all the way down to the April 18th level out at 27.30. That would be inside the NDX 100. So you did have some bulls that showed up inside the marketplace yesterday just simply by taking a look at that hammer candle, which I love from the standpoint of, you break those hammer candles and they give you a release of a ton of information to you. So that's what you're going to want to be paying attention to inside the NDX. Let's go take a look at the Dow. We haven't taken a look at the Dow yet, so let's go take a look at that index. Right now, the Dow is trading up 18 points. Is this going to be 21 sessions in a row or not? And if it is or it isn't, it's not going to change the market and its direction here, because the market is now getting ready to head south. No bullish candle at all forming yesterday inside the Dow, and the Dow was the leader. The Dow was up 138 points out here, but still no bullish candle inside that. You're still trading inside the bar here. From Friday, that open is 15,322. So far, the test this morning has been up to 15,294. As far as bearish candles out here, you had that key reversal session as well on May 22nd, also a bear sash candle. Another bear sash candle right here on May 29th out there. What is this really set up for us as the Dow moves down? The Dow will move down into May Day out here, which is the top, which is 14,839 inside the marketplace. Once it gets below the low of Friday, there's really nothing to stop it until it gets down to May Day, anywhere between 14,687 and 14,839 inside the Dow. As long as we're inside this tab, what else do I have? Well, let's go take a look at the VIX here. Let's go see what the VIX index itself is doing and did yesterday as well. The VIX yesterday creating a little shooting star, which is the opposite of the hammer candle. So that says resistance inside the VIX now, 1758. I expect that resistance is going to be taken out without too much difficulty. We can see the VIX here is now, is well above the 200-day exponential moving average. We know that you can start taking a look at bearish outcomes immediately when it gets above that 50-day, and that's what it did here on May 22nd of 2013. 877-927-6648. Dow's up 25. S&P is up about 2. Russell 2000, a little negative here, down 35 cents. We'll be right back.
The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartleys, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces. And over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
Steve takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Welcome back, folks. Dow up 26, S&P up 2.5, and let's go out to Philadelphia to our man John. Just a great tiger in the Tiger's Den. John, how you doing this morning?
Hey, Steve Rhodes. Good morning to you. I'd like to ask you if you could pull up the daily chart on the soybeans, November, the new crop soybeans, and tell me what you see, sir.
Well, I've got it. So that is the November contract. Well, tell us what you're doing out here first.
I'm looking to short it.
You are? Okay. So as we take a look at the November beans right now at 130.62 out here, this is so you're looking to short it. Let's take a look at any patterns out here that are in this contract. So give me a minute here to take a look at a couple of different things for you. So as we take a look at this, no bears have shown up in this equity just yet. Maybe today, if you were to get a close below yesterday's open, 130.04 out there, it certainly is in the overbought territory. I don't trade the beans, so I'm not as familiar with them. If we take a look at the descending trend line out here, coming off of the September 14th high, it has broken that. It broke that yesterday pretty much with conviction. If we take a look at the retracement off of the last high out here from February the 5th, you're up above that until the bears show up in this, which would mean a close probably below that trend line and the low of yesterday's open, it looks like it actually could go ahead and make a run for the swing point high of February 5th out there, right around 134.9. Is that what's going to be your signal for going short?
Steve, I'm in the den. I see the charts that you're posting in the den. It's terrific. I'll tell you, I love the way you start off looking at a pattern with your Ensign software and start doing your Pesavento patterns. I'm always interested to see fresh eyes looking for recognizable patterns. So thanks for putting that up. Let me share this with you. As you will see, November soybeans have rallied hard from about $12 even to about $13.30, literally in 10 days' time. I'd like to share with you and your listeners what is behind this move, and that would therein explain why I'm looking to short it. So this would be something more fundamental than technical. Yeah, I've got a fundamental view, and I'm looking, and then, I come up with a fundamental view. Then I look for the technical setups to confirm, providing me with a low-risk entry if I can find one. Oftentimes, of course, you can't find one, but this is the procedure I'm going through. Let me share with you fundamentally what's going on here. Yeah. Last year was a catastrophic drought year. We all know that. We all know that the corn and the soybean crops were obliterated. Thankfully, the southern hemisphere during our winter produced good crops, so we didn't have catastrophic spiking prices here, from January through March. Now that we're into the growing season here in the northern hemisphere, specifically the U.S., we've had plenty of water. The drought conditions throughout the heart of the Corn Belt, that drought condition is now totally relieved. I'll give you a quick data point that you and your listeners might be interested in. Specifically, last year, in the heart of the Corn Belt, Steve, in the past 100 years, last year's drought was the second worst in the past 100. I mean, it was just off the charts awful. And this year so far, what was behind that? If weather conditions have been good, what's been behind the move up in November? November beans? What's behind the move in the past 10 days? And exactly, good question. I will tell you, to relieve the drought, the past 3 months, March, April, May. Yes, Steve, it's been the wettest 3-month Iowa time period in like 40 years. I mean, just off the charts wet. Yes. So gone. The problem, however, is now it's too damn wet. Okay. And what's been going on here, corn gets planted first. You got to get the corn in the ground first. Farmers then do their soy. Yes. Farmers were delayed by 3-4 weeks getting corn in. Was that because of the rain or the winter? No, the rains. The rains in March, April, May. Yeah. On account of that, corn being delayed, and just to let you know, farmers with their, huge John Deere tractors have caught up, and they catch up very quickly once given the shots, to the point where corn is now almost fully planted. So people have caught up. Problem is, they were delayed getting the corn in. They've got the corn in, but now... Hey, John, we're going to go to break, but would you stay? Because I'd like to have this conversation with you. Because, number one, what I'd like the folks to do and understand is also how it is that you're going to pick out your possible profit targets. We'll be back with John in Philadelphia. We're taking a look at the November soybeans. We'll be right back, folks.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit. And on April 1st, Tom Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Welcome back, folks. The Dow's up 46 points right now, S&P up about 6, and we're going to go back out to Philadelphia to our man John in the den. You folks know him as Z. We're taking a look at the November soybeans contract here. John's taking a look at possible short entries, and John is updating us on more of the fundamental aspects of what is going on inside the Midwest, inside the Corn Belt, and so at this stage, from a timing standpoint, you see the farmers being able to get up to speed real quickly. Oh, do we still have John? Do we still have John? Uh-oh.
I'm right here.
Okay, cool. Okay. So go ahead. So now, also during the break and after our discussion, I'm going to come back to the 30-minute chart and take a look at it. But we were looking at the daily chart and maybe incorporate into to our conversation. What's the time frame that you'll use, or what time frames? Because I'm assuming it's more than one chart that you are looking at. In the soybeans, so you're taking a look at being able to take a short position, so what are the time frames that you're going to use to make that trading decision? Because you fundamentally, it sounds to me like you've got some sound principle as to a reason why there's been the run-up that, in my mind, what I'm hearing you say is it's really unsubstantiated over the long haul here.
Actually, Steve, that would be inaccurate to phrase it that way. To get to your preliminary question, that's always the most important one. Where, at what price do you want to sell it, what time do you want to sell it, and what's your target? What I will tell you is my speculation is beans somewhere around 13, right here, right now, has the potential to yield a target of $11 down 2 from here, maybe down to 10 into harvest, and that would be, September time frame. If in fact a couple of developments, farmer planting and Mother Nature cooperate. Hence, that sort of 20 to 30% profit potential attracts my attention. Of course, there's always fundamental factors that could be wrong with that scenario, and hence it becomes risky, and hence the need to absolutely fine-tune your entry to guard against the risk of big losses in the event that you're wrong. But let me just share the fundamental, because this is kind of cool.
Yeah.
Given that very wet spring, March, April, May, and May, as you know, in fact, just last weekend through the heart of the Midwest was very, very wet.
Yes.
Okay, so that delayed corn planting, and corn has to get planted first. It takes longer to mature. Beans take less time to mature, and then hence always get planted second, at least with a corn-soybean combo. Now, what has happened is this. With the delayed planting of corn, and mind you, as of last weekend, corn was virtually fully planted, but beans were only 57% planted as of Sunday, 57%. That compares to an average over the past 10 years for this time of year of 85% planted, so way, way behind.
Yes.
Now, what is at work here is this. There is a crop insurance deadline date that comes up here June 10th, June 15th. The specifics I don't know, but conceptually here it is. A farmer who doesn't have his beans in the ground by June 10th can go and say, I elect that I was prevented from planting, and I can make a crop insurance claim, and therefore I just don't plant, and then I will get an insurance payment. Now, the insurance payment is less than what you'd earn if you fully planted the crop and sold it at, I don't know, $12 a bushel.
Sure.
But at least it's better than nothing. So farmers are faced with this decision. Do I plant, or do I claim prevented planting here June 10th? Or, alternatively, do I let the deadline pass, prohibiting me from claiming the insurance, and plant later and take the risk that I get good weather and that the crop matures before fall frost? So that is what is at work here. So with the beans at 12, many farmers were thinking, I'm going to not plant. I'm going to claim the crop insurance by the June 10th deadline.
And that's what pushed the prices up.
And buyers know what the farmer is thinking. And if the farmer fails to plant those 3 million additional acres that are at play here, all of a sudden supply's less, price is going to be high later. So buyers, users, are driving the price up. They're buying right here, right now.
Yeah.
And this is giving the incentive. This is the market signal to the farmers to say, you know what, don't claim the crop insurance, the prevented planting crop insurance June 10th. And, in fact, go ahead and plant, after June 10th. Yeah. And if they do plant, and if Mother Nature cooperates the rest of the growing season, you could have, in fact, a bumper crop, and then price fall down to 11 or 10. So those are the fundamentals, and it's this quirky thing with weather combined with the crop insurance program details and these deadlines. and it gets dicey, and of course you never know what Mother Nature's going to bring, but there's an opportunity worth looking into, at least as I see it. So I wanted to see your fresh eyes on the pattern, and then just share those details with you.
Yeah, so on for the pattern, I'm assuming you're going to use some other type of intraday time period to make a decision, other than the daily chart?
Yeah, in fact, now that we've made a high, we're backing off. Now I'm looking at that hourly chart that you're looking at right here, looking for a decline and a bounce into resistance as an opportunity to lay off a short.
Yeah. So one of the tools that I like to use, to see if the strength behind the move is real or where there's some type of divergence, and it works on really everything. It works on commodities such as we're looking at here, the November contract for soybeans, works on the futures, works on equities here. And in fact, in my opinion, it answers all of the questions of any of the great crashes that we've had out there, because I've taken a look, as you have done. I love just studying the markets and understanding history, just simply because, how do you know where you're going to unless you know where you've come from? And you've used a lot of that information just on the fundamental aspects of how you analyze soybeans. In this case here, I like to take a look at the using that relative strength, relative weakness indicator, and we had soybeans on the 30-minute chart make a peak, John, at the 11:30 a.m. candle on May 31st when it got out to 13 out there, and it continued to move higher. And as it moved higher out there, now, in order to really have any divergence, you've got to have some type of price spread out here. So even though the next candle maybe started to get some bearish looks at it, maybe around 1:30 in the afternoon on May 31st, there wasn't enough price divergence in order for that to really, in my opinion, be a diverging pattern. But as price continued to move up, and you had a little bar here at 11 o'clock in the evening on June 2nd out here, just small-bodied candles that continue to move up. The first bearish candle that showed up on the equity here was at 7 in the morning yesterday, as it got out to 13.31.2. And so that was a reversal signal. And as it did that, the relative strength index was at a level of 79.03. Up at the high out here that we first used as our anchor bar was 85.25. To me, that says that the price move wasn't real. And you're looking for, where are the bears going to come in? Now, the bears then came in 2 candles later at 8 o'clock yesterday morning, and you saw your bearish engulfing. That would have been a trigger, in my opinion, from a reward to risk standpoint, that would have said, okay, now would be the time to take a trade. Whether or not that was a longer-term trade or not, that was your opportunity. That was a first opportunity, as I'm looking at it on this shorter-term chart here, in order to be able to take a trade. Right now, as I take a look at that RSI, you're really mid-stroke, so it doesn't give me a lot of information as to whether, I would be patient and just wait for the next setup, which might be, a bounce to 13.207 or something like that. But I would be watching for these divergences between price movement, because in essence that's what your, part of your decision-making process seems to be, that, hey, maybe this, because you've got buyers and you've got growers, and you're trying to get a read on who's right and who's wrong and who's going to do what. A lot of times it just really bears out in the chart here, and so that was that turned out to be a nice selling opportunity. Once price starts to get on the 30-minute chart, gets down into the over sold territory, that's when you can start taking a look at, do you take your trade off the table? Now, if you were short here, if you had gone short, if somebody had gone short up at this high, I wouldn't have taken my trade off of the table, primarily because of the bar at 11:30 last night, as the RSI was getting into the 31 level. And the reason is that I would make the market go ahead and convince me that by having some type of significant close above the actual body of that bar out here, which the open on that bar was at, looks like 13.112 out here, and we haven't seen that yet. But it looks like, to me, you just try to play the next retracement if you're thinking about now is the time, or just simply wait for that relative strength indicator to get up towards the top, above the middle section. But, use that. If you don't use that as a tool, it's a great tool out there on top of, additional tools that each of us use in our trading arsenal. So that's what, that looked like a good trade opportunity.
Steve, listen, thanks so much for that. As I'm listening to you go through that procedure, that 30-minute bar chart and application of the RSI divergence tool, that's very cool. And I admit I was not doing that Monday when I should have. But be that as it may, I appreciate that view. And just in parting, I might ask you,
yes,
if this particular chart for the next 5 days you might take a look at from time to time.
Yeah, I'll keep it. I put it in. I will. I've put it in my show charts button, so I'll keep it here. We'll keep coming back. We'll take a look at it. Yesterday as the market was moving down on the 30-minute futures, and I love trading the ES Mini and the patterns out here, and as it was moving down, as it got into, so at 11:30 yesterday morning, as the ES Mini got down to 1621, it was also making a lower low, but with higher relative strength. And the real signal where I went long was on that piercing candle that came in at 12 noon. A bit dicey there for about 2 hours or so, but it was the signal, and I take, like you say, you're just looking for a reward to risk, and it doesn't mean every trade's going to work out. And so there's another situation where there was a buying opportunity versus a selling opportunity. And if you use that tool as one of the tools that you use out there, I think you'll find it a nice thing to add to your Craftsman tool bag out there. So
Steve,
I will.
Thanks very much for your help. I do appreciate it.
Hey, my pleasure, and thanks so much for calling. Let's go to Lou in Nashua, New Hampshire. Lou, thanks for calling. Thanks for holding. How are you doing this morning?
Good. How are you doing?
I'm doing excellent. Thanks for asking. You want to take a look at the King dollar?
King dollar, yeah. Where do you think it's going?
It's interesting out here. I still am of the belief that the U.S. dollar index wants to make a butterfly expansion pattern. And so what that would say is that I believe that the pattern in the marketplace is for the U.S. dollar index to head to either 85.75 or 87.66. Now, when I use those numbers, I'm really using that as really the range out here. And if we take a look at coming off of a significant swing point high, which is June of 2010, down to the low of May of 2011, 85.62 to 85.75 is really the nut. I think that's where the U.S. dollar index is going to move to. Now, and the reason is no different than if we were to go take a look at the Qs or the NDX 100. When you break a 0.786 Gartley pattern, which is what the weekly chart now that we're looking at inside the U.S. dollar index broke, which it did the week of May 17th. It broke through that with conviction. It really says that it wants to go ahead and complete that next pattern up. Now, the U.S. dollar index has pulled back, but if we come off of the lows from September of 2011, all that it's really doing is it's gotten back down and it's really tested maybe the bottom of the rising price channel that it's been in ever since September of 2011. So everyone that does, think that the dollar's been trashed, it's really been in a rising price channel ever since the lows out here, really of May of 2011. But I'm using as my anchor point here for the bottom of it, the body of September 2nd, 2011. So I think the U.S. dollar index actually wants to move higher. Now, I will tell you that seems to be contradictory to what the large commercials in the CFTC data showed. I spent some time over the weekend, Lou, and what's interesting to me is that if you take a look at the basket of currencies inside the U.S. dollar index, so the euro, the yen, the Canadian dollar, the Swedish krona, I'm missing two others or what have you, and we're going to go to break here. But, Lou, that's my answer, is that I think that the U.S. dollar index is going to make an expansion pattern, and it's on its way up. Does that help you? Uh-oh. Folks, we'll be right back. 877-927-6648.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to tfnn.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of tfnn.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to tfnn.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of tfnn.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.
Catch Basil Chapman as he uses his Chapman Wave methodology to call the markets. The Tiger Technicians Hour, next on TFNN.
Welcome back, folks. Relatively flat market out here. Dow is up a point. You've got the S&P up a half a point out here. Russell 2000 struggling this morning, off $1.80. Net declining issues right now, 229. New York Stock Exchange is up 2 points. And, you know, we were talking with Z earlier, and we were taking a look at using an intraday chart, and just simply we were applying it to the November contract for soybeans. And what's cool is that, with regard to technical analysis, it really doesn't matter what the actual chart is. You're just really paying attention to the different patterns that are out here. And I love being a student of the markets. I think that's all that we are. We're not teachers of the markets. The markets are teaching us on a continuous basis. And the cool thing is that means there's always things to learn. Right now, I'm actually working on a set of tools. I ran my first tests over the weekend and yesterday, and it's using some of the lagging indicators. I've broken the lagging indicators into 4 different categories. There's 82 different lagging indicators that I'm using. Some are volume oriented, some are velocity oriented, and in each case I run those indicators through 1,600 tests, and I'm looking for a set of patterns that's different on each chart, where it provides the highest expectancy, trying to come up with the 4 best patterns that end up then being converged and using them like a weighting structure. In some cases, the stochastic might be the best signal, and that might get a higher weighting. In any event, I was kind of off target there, but I guess really my whole point is that being a student of the markets is, in my opinion, is the coolest thing. Now, if we take a look at, and I like to utilize, lunar strategies or what's going on celestial-wise or what have you, and what I loved being and still love being a student of is understanding, are there signals before there's any type of market declines? And that doesn't have to be a crash or what have you, but before any type of pullbacks, before any type of corrections, because that's really, if your attempt is really to try to sell at the highs and buy at the lows. So how do you really do that? What tools do you use? And so with Z in the Den, I use one that is nice to have with your trading arsenal. Well, what's really cool is I'm going to go back here. This is the Dow chart if you're watching this from 1928. And the Dow made a high out here of 350.09 on July 8th. And when it did that, the relative strength indicator was at 78.89. I'm going to draw a line going across the screen out here. And so we're going to take a look at when price moved. As I mentioned to Z, you've got to have a price variance inside the marketplace. And this is where it takes work. It takes a lot of trial and error to figure out what the proper price differentiation is before you actually have any divergence. But if we just take a look at the high that was made out there, and that was also the high in the relative strength indicator, and then the high that was formed out here on September 3rd, 1929, you'll see that RSI reading, or I'll tell you the RSI reading was 73.6. Yet back here when it was making a high in July of 1929, the reading was 78.89. So 78.89 versus 73.6. It was making a higher. Now, you got to wait for the bears to show up inside the marketplace. As I pull this back, even on this candle right here, which was August 23rd, 29, you can see price just moved with inside that candle. So, therefore, you weren't seeing any kind of really bearish signals here. This was not a bearish candle on September 3rd, but when you did get it was almost really like a spinning top candle. But when you go ahead and you use the following 2 candles out here, September 4th and September 5th, that told you to absolutely be careful inside the marketplace. And that was well before any kind of crash inside the marketplace. And we can go take a look at any of those time periods where you see significant declines in the marketplace, and also how to buy the lows. So it's kind of interesting here. I'll use the example at the lows out here. So here you had the market crashing down. Who wanted to buy it on October 29th? Well, that wasn't the day to buy it. The day to buy it, quite frankly, was on November 14th, 1929. You had a higher RSI reading in a bullish candle that next session. Folks, stay tuned for the next hour, and have a great Tuesday. I look forward to seeing you tomorrow morning. Take care, folks.